Hello and welcome everyone. Thanks for joining us today for this global webinar where we are launching the Global Sustainable Investment Review 2020 report. Very much welcome your presence here today to join us as members of the Global Sustainable Investment Alliance. We will be taking you through over the next 45 to 50 minutes, the highlights of the report. This year, you'll be hearing from a number of the CEOs from the members of the Global Sustainable Investment Alliance. We're fortunate to have on the line today the CEO of the US SIF, Lisa Woll, the chair of Japan SIF, Masaru Arai, and the CEO of Responsible Investment Association Canada, Dustyn, Lanz. And I am Simon O'Connor. I'm the CEO of the Responsible Investment Association Australasia, and also the current chair and hosting the secretariat of the GSIA. Today's report, we're really pleased to have sponsoring this report, Robeco and RBC Global Asset Management, and we just give a huge thanks to them for their support of this report. And if we move on 2 slides forward, we are about to launch this report today. This is the 5th iteration of a biennial study that the GSIA put out. The GSIA being the collaboration of the largest membership-based sustainable investment organizations around the world. In addition to the speakers today, we have members from the Netherlands, from the UK, from Europe, making up the GSIA members. We work towards a world where sustainable investment is integrated into financial systems and the investment chain, and where all regions of the world have coverage by vigorous membership-based institutions that represent and advance this community, the sustainable investment community. We work very closely with a number of other smaller membership-based organizations that are emerging in many, many countries and regions around the world. And you'll see in today's report, we do include an overview and some regional highlights from regions beyond those main regions captured in the report. The report includes highlights from China, from other countries across Asia, from Latin America, and from South Africa. Tonight, the agenda, I will be running through some of the highlights of the report, and then we'll hear some regional deep dives from the US, from Canada, from Japan. I'll cover off Australasia and some of the European highlights in particular. And we will have a chance at the end of the session to do some Q&A. So we ask that you put questions in the chat function or the Q&A function. We will endeavour to answer those. Any we can't take today's call, we will endeavour to come back. We'll also be sharing the recording of this, and the report will be circulated to everyone registered for this webinar as well. So welcome. Sustainable investment, as it's defined for this report, is inclusive of investment approaches that consider ESG factors in portfolio selection management across the 7 responsible investment strategies that are globally defined strategies with detailed global definitions, where our group is the GSIA, and indeed working with other sustainable and responsible investment bodies, have really converged and refined these definitions over a number of years. Those 7 strategies, as many of you will know and understand very well, include those such as negative and exclusionary screening, positive and best-in-class screening, norms-based screening, ESG integration, corporate engagement, sustainability-themed investing, and impact or community investing. And today's findings are all about that categorization of that inclusive approach to sustainable investment. In many markets, we're calling that responsible investment, and really aggregating those figures. And as you see here, really the top line of this year's report tells a story of a growing portion of the global investment industry that is now committed to sustainable and responsible investing. It really has become a major force in shaping global capital markets. And through that, it is starting to influence really heavily the direction and the flow of capital and companies that are seeking to raise capital. So what we find here at the start of 2020, where this data relates, we see that globally, the sustainable investment industry now is the equivalent of $35.3 trillion of global assets under management. A really significant step up over the last 2 years, and even more so over the last 4 years, where it moved from nearly $23 trillion up to 35 trillion. So on the next slide, we see that now equates to 36% of all professionally managed assets globally in these markets covered by this report, having grown again over the last period, the last 2 years, but again since 2016, having grown from about 28% to what is now 36%. So we're seeing a growing and a significant proportion of the global investment industry now committed to sustainable and responsible investing. When you look at those figures, you see around 80% of those assets covered in this report are made up of the US and Europe, primarily covering those regions. So that really has become the biggest regions there. But if we move on, we start to look at regional dynamics and regional growth in local currency in this chart that you see here. And you see that the fastest growing markets in that last 2 year period are led by Canada, having grown by 48% in that 2 year period, followed by the US, having grown by 42%, followed by Japan. So really strong growth rates of commitments and of investors delivering a sustainable investment approach in those major markets. But what's really fascinating in this year's report is that we also find ourselves as an industry in a major moment of transition and maturity, and one whereby different regions are tracking at different levels right now as they hit this transition period. So for example, really notable in this year's report is that you see the European figures there have actually dropped as reported in this report in that last 2 year period, dropping by 13%. And what has really driven this in the European context is that in Europe, we've gone through a phase where under the European Union Sustainable Finance Action Plan, we've seen a shift towards legislative definitions of sustainable investment that really tightened which of those investors can call themselves sustainable investors who are doing sustainable or responsible investing, and really lifted the bar in that sense, but also forced a shift whereby negative screening, ESG integration, stewardship practices really have just become the norm across the majority of the market, such that now that reduced figure of around 10, 11 trillion euros really reflects just those that are more aligned to the sustainable funds, funds that equate under the Sustainable Finance Disclosure requirements of those Article 9, Article 8, and Article 6 funds. So it really just starts relating to those more clearly defined funds. If we move to the next chart, you see this interesting dynamic at play in Europe, where proportionally there's been that decrease over time based on those reasons I've just explained, in particular about the defining sustainable investment through legislation and really lifting the bar on those requirements there, but also that this has really become hardwired in the mainstream of the investment markets there. You also see a drop in my region, in Australasia. And again, rather than this being driven by legislative standards lifting, this is really driven by industry standards lifting, whereby the data as it's gathered here has really set a new benchmark as to what you need to be demonstrating as a sustainable or responsible investor to be included in the data that's captured there. So we've seen an aggregate growth in AUM in Australasia, but a proportional reduction. So there's some interesting dynamics that we'll come back to quite a number of times, I think, in this webinar. If we move to the next slide there, what we see is that the predominant strategy globally around sustainable investing is ESG integration, followed by negative and exclusionary screening. I think what came through quite a few times in the research is that many of these strategies are just starting to be built in as really par for the course or really mainstream practice, particularly across Europe, where negative or exclusionary screening is really not even enough to count for the data in this report in the European context. Likewise, in my market, where tobacco screening is very commonplace, as is other negative screens, they wouldn't be adequate to be captured in this data, for example. So we're seeing this sort of a need to be demonstrating more than just having commitments and more than just baseline activities to start being captured in some of this data. If we move to the next slide, we see the change over time of these strategies. And really the couple of things that stand out here are ESG integration really continuing to lead the charge and step up quite dramatically there in terms of the proportion of the market and the assets under management invested under ESG integration strategies. Negative screening, you've seen it drop back a little bit, but again, that's more related to the fact that this is now part of the course in many markets as opposed to a distinctive strategy when it just includes one or maybe even two negative screens, such as in the case of European market and under the SFDR and European Sustainable Finance Action Plan requirements. You see corporate engagement and shareholder action stepping up there, and I think that's reflective of activity in many markets. Probably the other noteworthy element is really, the smaller bar charts up the top there, where we talk about impact investing, but also positive screening and sustainability themed. With impact, we see a little bit of growth and then a little bit of a reduction in the most recent period. But I think, in fact, that's probably offset by that big step up in sustainability themed investing. And I think when we look around globally, there is still some settling down of definitions and defining different strategies as they sit within impact or sustainability themed. And really that probably reflects that there is a growth overall at that end of the market, those sort of tilting towards more positive outcomes, targeting more positive outcomes, whether they sit under a sustainability thematic or another thematic approach or impact investing, we're still seeing more assets flowing to that end of the market. The next chart is just another cut on that and really looks at the regional shares by asset weight in the different sustainable investing strategies. So you see, some really big standout ones there. Negative exclusionary screening is really dominated by Europe, ESG integration by the US, sustainability themes, really a heavy dominance there by the US as well from an AUM perspective. And really interesting results around Canada with norms-based and corporate engagement and shareholder action. We'll hear a little bit more about that as we move into the regional highlights. As a final slide on the core data there, the next one really just looks to the proportion of institutional versus retail sustainable investing assets. And you've really seen that flatline over the last 2-year period, with retail sitting at about 25% of all assets counted in this report. I think that's a really interesting data point where, in fact, when we start talking about and looking at the regional deep dives here, we're actually seeing a lot of activity in the retail or the consumer-driven space. You would have no doubt come across many reports in the recent years of the rapid inflows into sustainability funds, sustainability products, etc. And so I think this is playing out differently in a few different markets, but certainly some of the consumer research we're seeing from across different regions really supports that consumer interest, that retail demand is growing in momentum, even if it's not necessarily showing up here yet in these data points. What I would like to do now, if we look at the top line there of about $35 trillion of assets now managed under sustainable investing strategies, 36% of all professionally managed assets, having grown 15% in the most recent 2 years. What I want to do now is sort of allow us to dig in a bit deeper into that. And I'm going to ask for some of the regional highlights to be described, starting with Lisa Woll, who's the CEO of US SIF. And I'll hand over to you, Lisa. Thank you.
Thanks, Simon. Thank you, everyone, for joining us this morning or this evening, wherever you are in the world, and particularly those who stayed up really late or got up super early to help us meet the need of presenting this to a global audience. So very happy to be with you today. As Simon said, I'm Lisa Woll. I'm the CEO of US SIF, and our trends report came out in November of last year. I'm going to share with you a couple of highlights from that report and perhaps some things that have happened since the report was launched that also tell the story about where sustainable investment is right now in the US. And if you're more interested in learning more about our report, you can find it on our website. But in our 2020 report, sustainable investment assets rose 42% from 12 trillion in 2018 to 17.1 trillion in 2020. They now account for 33% of total assets under professional management in the US, up from 26% in 2018. ESG integration is the largest strategy, and I'm just going to pause there for a minute because for so many years, the US was known as a country that did predominantly negative screening. I don't think that was ever actually the full truth, but really there has been a shift to ESG integration, I think in large part because of PRI signatories becoming the biggest strategy in the US. And that's applied to 16.1 trillion in assets, followed by negative screening across 3.4 trillion in assets. And obviously, as you can tell from this number, there are multiple investors using multiple strategies. So we're not double counting here. The top 3 specific issues for money managers and their institutional investor clients were climate change, carbon emissions, sustainable natural resources, agriculture, and board issues. Next slide. The largest percentage of money managers cited managing risk as their top motivation for pursuing sustainable investment strategies, followed closely by client demand. And then institutional investors discussed fulfilling mission and pursuing social or environmental impact as their top motivations. Investment firms and institutional asset owners representing 2 trillion in assets filed or co-filed shareholder resolutions on ESG issues in 2018 to 2020. What's interesting here also is, Simon talked a lot about how regulatory environments are changing both the way sustainable investment is done and how assets are counted. That's certainly true in some of our sister markets. What was true here is that even in an administration prior to Joe Biden, where there was absolutely no support for sustainable investment regulatory initiatives, nor for moving forward policy issues on issues important to sustainable investors, such as actually addressing climate or looking at wage inequality or the action of corporates in terms of providing decent benefits and pay. Nonetheless, in those 4 years of that administration, sustainable investment continued to climb. And under a new administration, what we're seeing is a much more supportive environment, just beginning with a holistic approach to addressing climate change, from embedding it across all the different federal agencies to understand climate risk, to executive orders on climate change, and just a whole range of other issues. There's also been a broad focus on corporations with anti-competitiveness policies that are negatively impacting workers, as well as looking at this whole conversation about stakeholder capitalism or more integrative capitalism, where we're looking at companies to have a much broader focus on communities and employees and not just on share owners. While that's not become a primary focus of the new Biden administration, it really is being thought about in a range of different agencies, including across the White House. So I expect we'll see more action there. We've also seen the Department of Labor commit to overturning 2 very bad regulations that came in under the last administration, which limited the use of ESG criteria and proxy voting in pension plans. There's also support in Congress for legislatively changing ERISA law so that we don't have to continue to rely on back and forth guidance at the DOL, and it makes clear that ESG criteria is appropriate for ERISA governed pension plans. The SEC has really just taken a running leap at a greater focus on ESG since acting chair Allison Lee was put in prior to the appointment of Gary Gensler as chair. There are now multiple staff members in the SEC that are focused on climate and ESG. There's an entire policy department in the chairman's office that is focused on ESG, with a recent hiring of someone, for example, who worked on shareholder engagement at one of the original SRI funds, Domini. So the SEC, which in many ways sets the rules of the road for the investment community in the US, is fully focused on ESG, including potentially looking at broad ESG disclosure in addition to their commitment to look at climate change disclosure, and potentially looking as well as how do you ensure that the way ESG focused products describe their ESG activities actually match reality. So not different in some ways from what you're hearing from Europe and Canada and Australia. So I believe that we're going to be able to see over the next few years, just not continued growth in the field, but also continued emphasis on social issues that became apparent during COVID and racial injustice protests that continue in this country, and as well as a greater focus on E issues and shareholder campaigns around a broader range of S issues. That's already started to happen this year, and I expect we will see that long into the future. Happy to answer any questions at the end. Feel free to be in touch with me also by email, and thank you, Simon, for the opportunity to speak.
Thank you, Lisa. That was a great thorough overview of the massive change underway in the US market. So thank you. I'm going to next hand over to the chair of the Japan Sustainable Investment Forum, Masaru Arai. So Masaru, welcome, and I'll hand over to you. Thank you.
Thank you. Thank you, Simon. First of all, well, this year's report covers the Japanese market, but also some other Asian countries like China and Korea. So I hope you find it very interesting development, what's happening in these countries. In Japan, the size of the market, ESG investment market, is a little bit larger currently than the Canada. So it's quite sizable nowadays. But that's critical driver of the ESG investing was the GPIF, the Japanese government pension fund, since it became the PRI member in 2016. And most of the leading Japanese fund managers follow that. And also in 2018, GPIF started diversifying their investment from equity to bonds, real estate, and alternatives. So these are the reasons Japanese ESG investing figures increased very quickly in the last two reports in 2016 and 2018. If you like to learn a little bit about the details of the Japanese market, please visit Japan Safe's homepage on the website, and you can find the white paper. We are covering the market every year in English. For the last 2 years, we have observed a little bit different development in the market, especially the regulators like Ministry of Environment, the Financial Services Agency, the Ministry of Economy, Trade and Industries, and Ministry of Foreign Affairs. These ministries played an important role and making guidelines and revised code. As listed here on the left-hand side, policy and regulations newly introduced or revised. The first one was the guidelines on social bonds, which the Ministry of Environment introduced, and it's aligned with the ICMA's guidelines. The second one is the revision of the Stewardship Code. That is very important. This was the second time since it launched in 2014. And the Financial Services Agency clearly mentioned in the Stewardship Code on sustainability and the ESG this time. The third one, National Action Plan on Business and Human Rights, was finally introduced last year by the Ministry of Foreign Affairs and the other 15 ministries after a long discussion with Global Compact, KDALAN, legal entity, NGOs, including Japan Safe. We participated at the advisory board and incorporate responsibility investors' perspective and their role in human rights. The action plan will be revised after 5 years. And during the 5 years period, we are expected to have the roundtable and discuss the development, what is happening during the period. Number 4 is the corporate governance code. And this is also revised by the Tokyo Stock Exchange. And the point is, it's clearly mentioned sustainability topics, including climate change, human rights, and the treatment on workforce. So this is becoming more clearly, clear guidelines for Japanese companies to follow these topics. And basic guidelines on climate transition finance is aligned with the ICMA's climate transition finance handbook. So lots of ministries have developed new guidelines or the revising the existing code. And recently, the Prime Minister Suga pledged to cut Japanese GHG emissions to net zero by 2015. And it's a clear sign by the Prime Minister, and most of the ministries are working quite closely to that target. And the 3 ministries jointly introduced recently a green growth strategies for achieving carbon neutrality in 2015. So this is really the first step. Japanese ministries talking about the clear and active actions taken to the carbon neutrality. On the right-hand side, other drivers I like to add is one is ESG disclosure group that is arranged by corporates, investors, and academics, and is discussing on the appropriate ESG disclosures. So it's also a first time that investors and the corporate are working closely how disclosures will help corporate and also investors and what they need for the as a content for ESG disclosures. And in retail market in Japan, the largest ever ESG investment trust fund was launched last year. And the fund size reached 1 trillion yen. That is equivalent to $10 billion US. Well, the retail market is quite limited yet comparing to other countries, but it's becoming to move forward. And finally, well, overseas investors, global investors, and activists. Well, in case of activists, including the Japanese activists, they started to play an important role in the Japanese market and also the ESG-related issues. And it's actually influencing the Japanese corporate governance. And finally, the COVID-19 is also influencing the Japanese market. Mostly actively discussing nowadays the welfare of employees of corporate and their supply chains. The ESG investing is a little bit lagging behind comparing to European investors, but now quickly catching up with them. Thank you. Thank you very much.
Thank you, Masaru. Thank you for that overview of the Japanese market. We'd like to now hand over to Dustyn Lanz, who's going to give us an overview of the dynamics in the Canadian market. Thanks, Dustyn.
Thank you, Simon, and hello, everyone. I'm going to spend just a moment talking about a few of the key data points, but then I'd like to actually spend my 5 minutes talking about some of the big catalysts in the Canadian market that are really going to be driving market development over the next few years. So in Canada, we counted 3.2 trillion in assets, and that's in Canadian dollars, aligned with one or more responsible investment strategies. This represents 48% growth over a 2-year period. and 61.8% of Canada's investment industry. So deep market penetration driven largely by our very concentrated market. We have a very concentrated banking sector and pension sector with between about 5 or 6 banks and about a dozen pension funds that are making up a large portion of those assets. The most prominent Arai strategies or responsible investment strategies in Canada by assets are ESG integration and shareholder engagement. And the top 3 drivers, according to the investors, are number 1, minimizing risk, number 2, improving returns, and number 3, fulfilling fiduciary duty. Now, in Canada and globally, we see that leading investors are adopting a stewardship mindset, which I believe is a critical starting point for capital to play a meaningful role in the transition to a low carbon or a net zero economy. A large portion of the assets reported in Canada and internationally tend to look at ESG factors from a risk management perspective as a risk input. But as we look ahead at the next phase of market development, I expect we're going to see more investors looking at ESG factors, not just as inputs, but also as outputs by turning their attention towards sustainable and inclusive outcomes. Now, I want to briefly just highlight a few major market developments that have been catalytic in the Canadian context and that I believe will be drivers in our market moving forward. Number 1, back in 2018, the Canadian federal government established Canada's Expert Panel on Sustainable Finance, which is a group of industry leaders to consult the market and issue a series of recommendations to align Canada's financial system with a sustainable future. In the summer of 2019, the expert panel released their report with 15 core recommendations for private and public sectors to take action. One of the key recommendations was for the government to establish a Sustainable Finance Action Council to coordinate implementation of the recommendations across public and private sectors. The pandemic slowed things down a little bit, but we're pleased that the federal government has now recently launched the Sustainable Finance Action Council in spring of this year. Canadian investors are quite supportive of this Action Council. Many of them, in fact, are on the council, and the market is eagerly waiting to see what comes out of their work in the weeks and the months ahead. Now, the private sector got to work on some of the expert panel recommendations right away upon the release of the report in late 2019. Specifically, one of the recommendations was for Canada's asset management community to establish a smaller local version of Climate Action 100+ to help Canadian investors engage with high-emitting companies that are too small to be included in the global benchmarks, which is a majority of our Canadian companies. So this global investor platform is now coming to life under the banner of Climate Engagement Canada. And this work is being convened by the RIA, our peer organization SHARE, as well as Series, and we have support from the PRI. We're just in the process of raising funds to support our capacity, and we expect to make an announcement in the next month or so, and then we'll get to work later in the fall. So you can stay tuned for more details about that. I briefly want to touch on a few other initiatives that are making waves in the Canadian market. In January of 2020, Canada became the first jurisdiction in the world to require diversity disclosures beyond gender for federally incorporated public companies. So listed issuers who are governed by the Canada Business Corporations Act are now required to disclose the number and proportion of women, Indigenous peoples, persons with disabilities, and people of color on their boards and in senior management positions. This has produced timely new data for investors who are increasingly focused on social issues to leverage for stewardship and engagement on corporate diversity. And this led us to develop the Canadian Investor Statement on Diversity and Inclusion just last fall. This is an anti-racism pledge signed by over, I believe it's actually 49 institutional investors now managing over $4 trillion in assets. Signatories to this statement have committed to promote diversity and inclusion in their portfolios and in their organizations. This joint statement has spurred collaboration amongst the signatories via investor roundtables and peer dialogues. We are now currently coordinating a joint statement for Canadian institutional investors leading up to COP26. This is called the Canadian Investor Statement on Climate Change. The draft includes a list of investors' expectations of companies, as well as commitments from investors. And I should note that the statement also covers Canada-specific topics, such as Indigenous rights, which are not covered by the global pledges. The statement is currently being circulated for comments, and we expect to publicize it in October with strong support from the Canadian investor community. And with that, I will pass it back to Simon.
Thank you, Dustyn. That's great. And just a bit, while I move into my section on some regional updates, I just encourage people also to put questions in the Q&A function or in the chat function, as we'll soon be moving into that section of the webinar. But before we do, I'm going to give a little bit of an overview of regional highlights from my part of the world, Australasia, Australia and New Zealand. And interestingly, a lot of similar dynamics at play, where we have around nearly 40% of the market committed to sustainable, responsible investment. And two different dynamics going on in our two little countries here, where very much in the Australian market, it's an industry-led, regulator-supported approach, whereas in the New Zealand market, it's a legislative-led, regulator-supported and industry-following kind of approach. So it's quite interesting to be watching the two dynamics at play in such close neighbouring markets. So we've seen some really strong signals from the New Zealand government, for example, one of the first to legislate mandated TCFD disclosures by financial services organisations, also embedding it into the default pension system, a requirement around responsible investment, and even being as prescriptive as requiring fossil fuel exclusions from default pension funds, which I do think is one of the world's first pension systems to require that. In Australia, our regulators have been very strongly focused on climate change risk, effectively requiring mandated disclosures around those. Our stock exchange has been moving forward, but as is no surprise to most, our federal government at a higher level has been somewhat absent from a discussion around sustainable investing, responsible investing, and indeed that is aligned with our absence around strong commitments around climate change as well. And so that has really led an interesting dynamic whereby in the Australian market, the industry has really taken the reins and pushed this discussion forward. So two major developments that have really pushed this, this agenda forward in the last couple of years have been industry-led initiatives to drive sustainable finance roadmaps in both Australia and New Zealand. Really, it was a function of the industry here all participating in global capital markets, seeing the rapid emergence of policy and regulatory settings in other markets in which we're doing business, and sitting here being the receivers of those policy developments, coming together and saying, right, we as investors, bankers, insurance need to sit around a table and actually craft up our own sustainable finance roadmap and make commitments around what we commit to do as an industry in terms of our disclosures, our reporting, our labeling requirements, our work on taxonomies, etc. And so late last year, we had the launch of both Australian and New Zealand sustainable finance roadmaps. We're just days away from launching the permanent bodies, the Centre for Sustainable Finance in New Zealand, and the permanent Australian Sustainable Finance Initiative in Australia that'll be announced this month. So I call us the fast followers, not the laggards on that front, but certainly it's a different dynamic that's sort of driven that on our side of the world. Probably the only other thing to note is really in the markets over this side of the planet, the demand side in interest is really starting to gain traction and really starting to shape the response by investors. Certainly we are seeing in the consumer research we do, a vast majority of consumers and citizens in our markets really requiring and demanding a responsible investment, sustainable investment approach to their retirement savings. So that has really driven things quite heavily in this part of it, and I think has a long way to run still as both asset owners, pension funds and asset managers respond to that, and financial advice community quickly act to respond to that as well. I just want to give a brief overview also on the European developments that are so significant in this report. Really, as we touched on earlier, those regulatory drivers have been huge in the European market, and really very much setting in train, hardwired, codified, legislated requirements around sustainable investment to the level of, you know, the Article 9, Article 8, Article 6 definitions, which has really shifted the industry dramatically there. So really disclosure of how sustainable risks managed is now key under European law. Really, many of the responsible investment strategies that we're seeing in these reports have really become expected practice. And so hence you see this apparent reduction in the total AUM figure in the EU, But in fact, the same amount of investors are still practicing those same responsible and sustainable investment practices, yet only part of that market really are meeting now the higher EU legislated requirements. We're seeing also that increase in the demand side. So the volume of sustainable fund labels are increasing across Europe. You're seeing over 1,500 funds with sustainable fund labels, equaling around 827 billion euros in that market now invested through those sustainable fund labels. And so we're seeing really strong inflows, really strong consumer demand. The legislative lever again of MiFID II is seeking to really steer more of that interest towards retail products by requiring financial advisors to ask about the sustainability preferences of their clients as part of that know your client process under MiFID II. So it's really interesting to see the different drivers at play. In the report, and I'm not going to try to cover them all today, but we do have really deep dives, also regional highlights on the UK, the data of which is captured under the European data in this report, but we do a separate regional highlight for the UK. We also see a really detailed summary on Chinese market from China SIF that we're really pleased to partner with for this report too, and get some very strong data out of China, a very fast emerging market with a strong policy push really around green finance, large increase in China around the mutual fund sector as well. And interesting to note how China is now co-chairing the International Platform on Sustainable Finance with Europe to really drive a broader approach to taxonomy and a broader common taxonomy. So there's strong momentum there. The report also includes regional highlights on Latin America, South Africa, and some other Asian markets such as Korea as well in the report. And so with that, I'm seeing that the chat function and the question function is rising. What I might actually do, I know there was one early question relating to the US market, a question around sustainability themed funds being so big in the US. And I wondered if I could pass to Lisa to cover that one off first. Lisa.
Sure. I don't know that I can speak to why it's larger than the rest of the regions or countries covered in this report. What I would say is in the US, we have a relatively long history of kind of themed funds going back to climate change funds before climate change was, such a big part of ESG integration and corporation in general, to sustainable agriculture funds. And in the last few years, we've seen such an interest in gender equity finance, gender lens investing. Those are two ways to refer to it. Additionally, what we've seen in the last 2 years is a big take up on addressing racial justice and diversity issues. So we have a couple of ETFs in the US market that are focused on racial justice. And I expect to see more of that. An issue that is sort of rising as an investor issue in the US is disability. And there's been conversations about, is there a way to address disability through something like a themed fund? And so this seems to be a way that both funds can distinguish themselves by having this more micro-focused thematic piece, but also it very much reflects issues that are rising to importance in the sort of general public and in the general context of where we need to see public policy. And I oftentimes find here that if there isn't a public policy answer to a particular problem, that sometimes that gets taken up by investors. And that also contributes to the theme. But that's why I think we're seeing it in the US market. And it's not different than in the past. We've had a strong focus on themed investing for quite some time.
And Lisa, would you like to take another question there, which was really sharing your views on how the pandemic would have impacted ESG investing across the globe? Do you have any response to that one?
Yeah, well, sure. We'll certainly know more, but we asked a question in our trends report on what folks thought the impact of COVID would be. And very much something I referenced earlier in my remarks, that there would be a stronger focus on social, right? Because we saw not just so many communities of color and frontline workers being impacted by the pandemic, but we saw for real that even for these workers who were putting their lives at risk, the end result for many companies was that they didn't increase wages or benefits, and people had hoped that would happen. And so what you saw in the proxy season, the shareholder season in the US this last spring, was a much stronger focus on diversity, equity, and inclusion, some workers' issues, so a strong push on social issues that we hadn't seen before. I expect we'll continue to see that. And all the inflows into ESG funds this year are showing a significant increases. So I think that COVID has led to a burgeoning interest in assessing how investors and companies deal with incredibly important ESG issues. And I think if anything, it's going to drive further interest, not pare it back.
Yeah, great, Lisa. And I think the data is seeming to confirm that, that as well. So that's great. Dustyn, there's a question directly on why you think stewardship has become such an important part of the Canadian market. And if you wanted to respond to any of those early questions too, I'd welcome your response.
Thanks, Simon. It is a good question. I was just trying to think of what my response would be. And so I'll preface my response by saying this is not a data-driven response. This is my interpretation based on what I know about the market. And so in Canada, we have a relatively small market. You know, in the US, you have the S&P 500. Well, in Canada, we've got the TSX 60. So it's a smaller market, everyone knows each other. And so our shareholder activism tends to be a little bit less antagonistic than you might see in some other markets. So I guess I'm pointing towards a little bit of a culture, I think, difference. You know, Canadians have a reputation of being polite, at least to your face, we'll be polite. But I think that's part of it. And, you know, we do have a very large energy sector. And so it's not easy to, you know, diversify away from climate change or from energy in Canada. And so I think that also contributes to taking more of an active ownership approach and leading to more focus on engagement rather than divestment in terms of affecting change. So that would be my anecdotal take on that question.
Thanks, Dustyn. I wanted to address one of these questions. In the report, we give a cautionary note on comparability between data from different vintages of the report due to the tightening of standards regulations, which makes absolute sense. But is there a way to recast the historic data by applying the new standards, such as that there is a like-for-like view? So what we try to do, this data comes from the best available research, primary and secondary, from each of the regions as to how we're each defining our regions and measuring our regions. And then we aggregate it up as a GSIA report. And so what we try to do is be true to the current definitions and current state of markets in each of our regions at a point in time and aggregate that up. And so there's not really been an attempt to, nor do I think a fair way to do that, to recast data applying these new standards. I'm sure there's lots of people who could have a go at trying to do that, but I think we have not in this report tried to recast that in that way. The second part of that question was being intrigued by the decline in impact investing. Now, I think that's a really interesting one, and I alluded to it in the discussion there, where I think, in fact, as you've called out in that pillar there, John, there is an awful amount of activity, a lot of activity in impact investing globally right now. And I think what's going on is, and it goes to one of the other questions who's asked about, you know, how do you define impact investing in listed equities? I think what we're still finding in many regions of the world is this debate and discussion as to what sits as a, you know, capital I impact investment versus a thematic or small I impact, you know, skewed or thematic investment. And I think what we're seeing there is a little bit of movement between the definitions of what I would see on the spectrum as sort of as sustainability themed flowing quite closely into impact. Now, many of us in our own markets are doing a lot of work to really hone in those definitions and get quite specific around them. I know we all look at the work of groups like GIN and the Impact Management Project, and really there's a lot of great work going on. So we're both guided by that and trying to shape that. And I think overall, what I would see from that data, my sort of takeout is that actually in aggregate, when you look at that sustainability thematic, impact, positive screening, there's really a growth at that end of the segment, end of the market going on. And I think one way or another, that is all aiming to achieve positive outcomes as opposed to avoiding harmful activities or just managing risk. And so we then go down to a discussion on them, sort of the details of definition there. And I guess that was a question to us, so we're not going to be able to avoid it, which is something about how we, our views on defining impact investing in public markets and particularly large cap equities. Now, you're probably going to find a few different views on this. And so it's a potential can of worms to open. And I know the GIN's doing a lot of work on this. I know each of us in our markets have views on it. Just from a personal perspective, from RIA in our market, we certify investment products, and we are finding a lot of products come into us as impact products, some of which are listed equities funds. Now, for the most part, we've not certified them, as we feel like many of them don't meet the criteria required for an impact investment, i.e. particularly additionality. The intent is okay, the additionality is hard to prove. We have, however, started certifying a couple of products that are listed equities. And in fact, to that regard, we've just issued a guidance note on how we define impact in listed equities, which I'm happy to share with you. One of the other questions there, and I'm going to kind of move on because I know we could spend an hour talking about that topic, and so I'm going to try to avoid us doing that in the last 7 minutes we have. A comment there just around the CFA Institute's draft ESG disclosure guidelines. Thank you for that question. So I think the distinction here is that they will be really formative, I think, and they will be taken up. I know in Australia, I know Dustyn in Canada have a firm view that they'll be really informative in shaping the level of disclosure and transparency around claims and products that are ESG, sustainable investment, responsible investment. And I think it's an important step forward. We're really pleased. We've been engaging really closely with the CFA on it. They're about disclosures around portfolio and transparency of process and approach. They're very much not about the outcomes, the sustainability outcomes of a sustainable fund or a responsible fund. And so I think your question there, part two, sort of asks about what does that effect might that have on product labeling? And you note our own product label in Australasia, which is our certification program. And what the product labels are often about is how sustainable or how green or how environmental is your fund. So we see them as really complementary. We see the CFA's guidance as actually underscoring the importance we place through our certification program of transparency, disclosure, clarity of claims being made. But then what we try to do in our labeling program is then also rate the level of sustainability outcomes from a product as well. And so we see them as quite complementary. And I think what we're starting to see is this will help to find that the all important kind of convergence globally of some consistent standards that I think are really important and will help this market as it comes together globally. Now all the questions are coming through. Okay, let me see. I should just pause because I should ask any of my colleagues if they had anything to add to those 2 or 3 questions I've just covered off on. You need not, that's fine. I know as I said, we could go really deep on some of those. Just a quick couple of questions I'll answer off in our last couple of minutes. The GSIA, when was it established? It is about 12 years old now. And this is the 5th iteration of a biennial report. So for 10 years, we've been issuing this report. What we saw, and the question was, why did we decide to issue this report and what was the original purpose? What we saw is that groups like ourselves around this table are all deeply embedded in local and regional markets. We see ourselves as having deep local networks, connections, and access to research and data. And most of us are doing detailed search reports on the dynamics, and we saw the value in aggregating that information, those insights at a global level, where we could have a global view of deep market nuances and differences. And what we found is our members combined, we have well over 2,000 members who manage many, many trillions of dollars of assets, see it as really valuable to understand what our neighboring and other markets globally, how they are developing and changing over time. And so I think for most of us active in our local markets, or for many of our members with the nature of global capital markets, we are all being influenced by developments in other markets. And so it's been increasingly important that we share that knowledge from across those different markets. Lisa, sorry, I should ask if you would like to add anything to that one. My apologies.
No, sure. Simon's right. We've officially formed a kind of collaboration a little over a decade ago. I think, most of the groups involved on this call and who are not involved in this call because they didn't have reports to distribute, but they still have SIFs. They've been around for over 20 years. And so there was always an informal collaboration conversation between the SIFs to learn what was happening in their markets. And we met and decided that we would all be better served by having a secretariat. And so RIA is a secretariat now, and it has been sitting at different SIFs over the years. One piece that Simon didn't mention that I think is really important is that we also try to, as a GSA, we try to be a helpful set of actors to SIFs and initiatives that are starting in countries that are newer to sustainable investment. So we'll often be reached out to by a country that is trying to create some kind of partnership or a body of sustainable investors to do something similar to what US SIF or RIA, UK SIF is doing. And we try to provide them with the benefit of our expertise on how to move that forward. So we see ourselves as not just pulling together data, putting out reports, putting out other thought leadership, but also trying to bring other parts of the world that are slower to come to the sustainable investment space and help them move forward. So we see that as an important part of our work as well.
Thank you, Lisa. Part two of that I'll address very briefly was the reduction in Australasia of the proportion of the industry was really driven by an articulation by the industry to say, okay, and us in particular, are really raising the bar on what would be included in our local version of our trends report, and really articulating that we've shifted to a point where it was no longer adequate just to have commitments and strategies in place. You need to be able to demonstrate a leading practice to be included in that report. And that's really consistent with our approach, trying to build the standards of practice in our market. And so in the market, we still have over 60% of the market committed to responsible investment, but only a proportion of that, around half of that, who actually can demonstrate and substantiate what that looks like in practice. And so we shifted a methodology to really push that higher standard approach, noting the trajectory that was going on in other parts of the world. So I really appreciate everyone's questions there. I think we got to most of them, and I appreciate those who have made it through nearly an hour of this. So high level, we're seeing really strong growth in this industry globally. It's really become a strong force shaping capital markets and those trying to raise capital off global capital markets, and some really interesting commonalities amongst the different regions of standards and lifting expectations that sustainable investors are really heading towards. Best practice is really strengthening. Regulatory drivers are pretty consistent in many parts of the world now. And so there really is a new stage, a new transition into a new phase for sustainable investment that I think is a really important one at this point in time, at 2021, as we start a really critical decade for this planet. And this massive shift we're seeing towards net zero, for example. I think it's a really important role that sustainable investing can and must play in the delivery of some of these objectives and supporting those. So what we see here is a market where this is now requiring more than just commitments and strategies, but really sustainable investors really need to be understanding the short and long-term impacts that they're having from their sustainable investment approach. We're all, as the GSA, working on this in our markets, really progressing that. We really encourage you in the many markets around the world to come and approach us, to be part of our networks, and to join us on this mission. And with that, I'm just wanting to give a huge thank you to our sponsors who allowed us to put together this research this year, Robeco and RBC Global Asset Management. A huge thank you to you both, our research partner, their Point Advisory. You can certainly follow us on our socials, website, etc. And please do hook up with us. And a big thank you, of course, to our fellow speakers and other regions, Europe, UK, Netherlands, China, other parts of the world that have provided us input and data into this report. So we encourage you to read the report. It's a lot of really important information in there that I think you'll find really insightful. And thanks to our speakers today, and thank you finally to all of you who have joined us for this webinar. I'm going to then close up the session with that and say good day, good night, good morning, wherever you are around the world. So thank you all.